Good evening. This is a breaking financial news update that demands your immediate attention. We have just received word of an extraordinary and sweeping change in the exchange rate between the Vietnamese Dong and the US dollar. The implications of this announcement are profound, and markets around the world are reacting with a degree of shock and urgency that we rarely, if ever, witness. I urge you to stay with us as we walk through what this means, why it matters, and how individuals, businesses, and economies will respond in the hours, days, and weeks ahead. We begin with the essence of what has transpired. The Central Bank of Vietnam has unveiled a massive, across-the-board adjustment to its dong-to-dollar exchange rate regime. The official rate has been reset dramatically. The dong has been devalued by a staggering margin, nearly 15% overnight, against the US dollar. The move comes as part of an urgent revision of monetary policy, intended to inject flexibility into the exchange rate, bolster export competitiveness, and absorb external shocks. The news came suddenly, catching investors, importers, exporters, and everyday businesses off guard. This is an abrupt departure from prior policies, which had focused on gradual, tightly managed exchange rate shifts. The rapid scale of today's adjustment has rattled markets and raised pressing questions about the underlying impetus. As you might expect, the reaction has been immediate. In the foreign exchange markets, the dong plummeted sharply as traders rushed to recalibrate their positions. The Vietnam US dollar spread widened explosively, pushing the official rate into uncharted territory. Forex desks and interbank markets pivoted at full speed. Global financial news alerts flooded screens. This shift marks the most dramatic correction in the dong's value in recent memory, forcing everyone from multinational corporations to small importers to reassess their risk exposure instantaneously. The ripple effects have begun to extend across commodities, corporate earnings estimates, trade balances, and confidence in emerging market stability. At home in Vietnam, businesses that relied on imported raw materials denominated in dollars face immediate cost pressures. Manufacturers and retailers are calculating new cost structures, and the specter of inflation looms large. Consumers fear rising prices on everyday goods, from electronics to machinery to simple grocery items that depend on imported inputs. Meanwhile, exporters are seizing an unexpected advantage. Vietnamese goods have just become significantly cheaper for overseas buyers. The export sector is poised for a surge in competitiveness, though concerns linger regarding supply chain capacity and the response from trading partners. Government officials and economists are moving into overdrive. The Ministry of Finance has convened emergency meetings with representatives from state-owned enterprises and private manufacturers. The central bank has issued a statement emphasizing that the devaluation is a deliberate strategy, designed to restore equilibrium after mounting external pressures. Officials argue that foreign reserves remain robust enough to manage market volatility and that the devaluation offers a strategic edge in global trade. Yet critics caution that this may just defer deeper challenges, for example, dependence on imported energy, structural inefficiencies, or persistent inflationary tendencies. Turning to global markets, analysts are taking note. Investors in emerging market debt are monitoring Vietnam's sovereign bonds closely, assessing whether higher inflation may undermine creditworthiness. Equity markets in Southeast Asia are adjusting forecasts dramatically. Banks with exposure to Vietnamese assets are in the spotlight. The sudden currency shift sends tremors across regional markets, prompting reevaluations of valuations, risk premiums, and cross-border flows. It also raises challenging questions for multinational companies with supply chains involving Vietnam. How will cost structures shift, and will those changes prompt strategic relocation or hedging maneuvers? This news also raises geopolitical and policy concerns. The United States may respond with heightened scrutiny, perhaps escalating calls for currency manipulation investigations. Trading partners may question whether this sharp devaluation was designed purely for competitiveness or to offset structural imbalances. In domestic politics, voices are framing this as a high-stakes gamble. Supporters frame it as bold, proactive leadership in turbulent global conditions. Critics warn of increased inflation, reduced purchasing power, and pressure on households. The political stakes are high, and the narrative will be shaped significantly in the coming hours. Let's delve deeper into the mechanics. In the days leading up to this, subtle shifts in the interbank dong-to-dollar rate began to surface. Analysts had observed a slow drift, but nothing like today's quantum leap. Now, with prices jumping by nearly 15%, every hospital, school, transport business, and shop must recalculate budget projections. Contracts denominated in dollars are suddenly costlier. Individuals holding dollars, whether in cash or accounts, have seen their holdings gain value instantly, but those paying rent, tuition, or invoices in dollars now face mounting bills. Migrants working abroad may feel pressure as they send remittances, both in terms of supply and demand. If inflation blossoms, wages may not keep pace, especially in the informal sector that dominates Vietnamese labor markets. As we parse the chain reaction, international lenders and multilateral institutions are closely evaluating what this means for Vietnam's credit trajectory. Will the devaluation aid by driving export growth and reducing external deficits? Or will it sow inflation, erode confidence, and escalate debt burdens? If reserves come under stress due to capital flight, the central bank may need to intervene more aggressively or risk deeper instability. Market observers are watching commodity markets too. If import costs rise, domestic prices for oil, metals, and food may climb more steeply. A cycle may begin where workers demand higher wages, producers raise prices, and the central bank faces pressure to hike interest rates, potentially slowing growth. Let me clarify the urgent implications for ordinary people. For consumers, it means prices on imported goods, especially fuel, electronics, and luxury items, could rise sharply. That hits the cost of living. For businesses reliant on import-heavy supply chains, profit margins could erode unless they can pass costs on to customers. For exporters, demand may surge, but they may struggle to expand operations quickly enough to meet new interest. For exporters with debts denominated in dollars, their repayment burden just got lighter in dong terms, but for those who took dollar loans, caution is advised. In the financial sector, banks may face a mix of windfalls and woes. Those holding dollar reserves benefit from the higher apparent value of those assets. At the same time, non-performing loans may rise if borrowers struggle to service dong-denominated debts amid rising inflation. The banking regulator will need swift recalibrations, raising capital buffers, managing liquidity, and monitoring risk concentration. Central bank lending facilities may need to be adjusted to support liquidity and forestall credit crunches. Regulatory agencies are surely convening right now. Looking abroad, Vietnamese sovereign bond spreads have widened. Investors are pricing in higher risk. Portfolio flows are adjusting on emerging market indices. Some hedge funds may short Vietnamese debt, at least temporarily, while others may long exporters or dollar earnings firms. Currency strategists globally are repricing models, adjusting forecasts, and revising risk premia. The narrative of a fragile emerging market has returned to the mainstream, albeit briefly. But we must watch how quickly volatility subsides and whether a return to calmer, more predictable forex policy will follow. In terms of macroeconomic balance, Vietnam's trade balance may improve in the months ahead, but that depends on whether export volumes rise and whether import volumes contract. Energy importers, especially in